I've been watching something develop in the US Treasury market that genuinely concerns me. And what concerns me even more is that almost nobody is talking about it. Mainstream financial media mentions it occasionally, but they don't seem to grasp how serious this is becoming. Here's the situation. The United States government needs to borrow massive amounts of money. We're talking over $8 trillion in 2024 alone. That's not just new deficit spending. That's mostly refinancing existing debt that's maturing. The US has to find buyers for this debt every single month at Treasury auctions. For decades, this wasn't a problem. Foreign governments, especially China and Japan, were reliable buyers. They would show up at auctions, buy hundreds of billions in treasuries, and everyone went home happy. The system worked, but that system is breaking down right now, and the consequences could be severe. Let me show you the numbers because this is where it gets alarming. According to the latest US Treasury international capital data, China's holdings of US Treasuries fell to $759 billion in December 2024. Let me put that in context. In 2013, China held over $1.3 trillion in US debt. They've reduced their holdings by more than 40% over the past decade. But it's not just the long-term trend, it's the acceleration. China has been reducing Treasury holdings for 9 consecutive months as of the latest data. This isn't random fluctuation, this is a systematic, deliberate reduction. And it gets worse. That $759 billion figure is the lowest level since 2001. We're talking about 23 years. China is literally back to where they were before they became a major US creditor. Now, some analysts will say, well, China is just moving holdings to different custodians like Belgium or Luxembourg, so the real number is higher. And there's some truth to that. Some Chinese holdings are held through offshore financial centers and don't show up in the headline number. But even if you adjust for that, the trend is unmistakable. China is reducing exposure to US debt. They're diversifying into gold, into other currencies, into infrastructure investments, into anything that isn't dollar-denominated bonds issued by a government running $2 trillion annual deficits. And China isn't alone. Japan, historically the largest foreign holder of US Treasuries, has also been reducing positions. Japan's holdings fluctuate more because of currency hedging and other factors, but the overall trajectory is downward. Think about what this means. The two largest foreign creditors to the United States are both stepping back at the same time. And this is happening while US borrowing needs are exploding. Let me break down the borrowing math because this is critical. The US federal deficit for fiscal year 2024 was approximately $1.8 trillion. That's the gap between tax revenues and spending. So the Treasury needs to issue $1.8 trillion in new debt just to cover that gap. But that's only part of the story. The Treasury also needs to refinance all the existing debt that's maturing. When a 10-year Treasury bond issued in 2014 matures in 2024, the government has to pay it back. And since the government doesn't have a surplus, it pays back that bond by issuing a new bond. The total amount of debt that needs to be refinanced in 2024 is massive. Over $8 trillion when you include both new deficits and maturing debt. The government needs to find buyers for more than $8 trillion worth of bonds this year. Now, under normal circumstances, this would be manageable. The US Treasury market is the deepest, most liquid bond market in the world. There's always been demand. But these aren't normal circumstances because at the exact moment when the Treasury needs to sell record amounts of debt, the traditional buyer base is shrinking. Foreign official holdings of US Treasuries, that's central banks and governments, have been declining as a share of total debt outstanding. In the early 2010s, foreign official holders owned about 30% of marketable Treasury debt. Now it's closer to 20% to 22%. That's a significant shift. It means more of the debt has to be absorbed by domestic buyers, US banks, pension funds, insurance companies, and ultimately the Federal Reserve itself. And here's where it gets really problematic. Look at what's happening with yields. The Federal Reserve started cutting interest rates in late 2024. They cut the federal funds rate by 100 basis points, a full percentage point. Normally, when the Fed cuts rates, Treasury yields fall too, and that's how it's supposed to work. Lower short-term rates from the Fed translate into lower long-term rates for Treasury bonds. But that's not what's happening. The 30-year Treasury yield is near 5%. The 10-year yield is fluctuating around 4.5% to 4.7%. These yields are higher than they were before the Fed started cutting. That's a massive red flag. It means the market is pricing in something the Fed isn't acknowledging, and what the market is pricing in is reduced demand. When you have the same supply of bonds, or increasing supply, but fewer buyers, the price falls. And when bond prices fall, yields rise. It's that simple. So what we're seeing is a buyer strike. Not a complete strike, but a meaningful reduction in demand from the traditional sources. And the government is responding the only way it can, by offering higher yields to attract buyers. But higher yields create their own problems. The US government currently pays over $1 trillion per year just in interest on the national debt. That's more than the defense budget. That's more than Medicare spending, just interest. And that $1 trillion figure is based on the average interest rate on all outstanding debt, which includes a lot of old debt issued when rates were much lower. As that old debt matures and gets refinanced at current higher rates, the interest burden increases. If the average rate on US debt rises from roughly 3% to 4%, the annual interest bill increases by hundreds of billions of dollars. That larger interest bill increases the deficit, which requires more borrowing, which increases the debt stock, which increases the interest bill further. This is what's called a fiscal death spiral. Higher rates increase the deficit, which requires more borrowing, which pushes rates higher, which increases the deficit more. It's a self-reinforcing negative feedback loop. Now, the Federal Reserve has a way to break this loop. They can step in and buy treasuries directly. This is called quantitative easing or debt monetization. The Fed creates new money and uses it to buy government bonds. This artificially increases demand for treasuries, which supports prices and keeps yields from spiking. It also makes it easier for the government to finance deficits because the Fed is essentially printing money to fund government spending. But there's a catch. Monetization causes inflation. When you create new money to finance government spending, you're increasing the money supply without a corresponding increase in real economic output. More money chasing the same amount of goods and services means higher prices. The Fed already tried massive monetization from 2020 to 2022. They bought trillions in treasuries and mortgage-backed securities. And what happened? Inflation hit 9%, the highest in 40 years. So the Fed is stuck. If they don't monetize the debt, yields could spike, borrowing costs explode, and we get a fiscal crisis. If they do monetize the debt, we get inflation, currency debasement, and loss of purchasing power. There's no good option. This is the impossible corner that decades of deficit spending have painted us into. Let me talk about who's buying treasuries now, because understanding the buyer base tells you how fragile this situation is. Foreign official buyers, central banks and governments, used to be the largest and most reliable group. They're now reducing holdings. So who's picking up the slack? First, domestic banks and financial institutions, but they're price sensitive. They'll buy treasuries, but only at yields that make sense for their portfolios. If yields aren't attractive enough, they step back. Second, primary dealers. These are the big banks, J.P. Morgan, Goldman Sachs, etc., that are required to participate in treasury auctions. If there aren't enough other buyers, primary dealers have to absorb the unsold bonds. Then they try to resell them to clients later. But if primary dealers are consistently absorbing large amounts at auctions, it means demand is weak. And it means they're building up inventory they can't easily offload. That's a warning sign of market stress. Third, the Federal Reserve itself. Even though the Fed has officially ended quantitative easing, they still hold trillions in treasuries on their balance sheet. When those bonds mature, the Fed has to decide, do they reinvest and buy new treasuries, or do they let the bonds roll off and shrink their balance sheet? If the treasury market is struggling, the Fed will likely reinvest to support demand, but that undermines their inflation-fighting credibility. Fourth, retail and foreign private buyers, individuals, hedge funds, foreign corporations. This is the most unpredictable category because they're driven by relative value. If treasuries offer good returns compared to other assets, they buy. If not, they don't. The problem is that the reliable, non-price sensitive buyers, mainly foreign central banks, are disappearing. What's left is a buyer base that demands higher yields to compensate for risk. And what risks are they pricing in? Several. First, inflation risk. If inflation picks up again, treasury holders lose purchasing power. They want higher yields to compensate. Second, fiscal sustainability risk. Investors are looking at $36 trillion in debt, $2 trillion annual deficits, and asking, Is this sustainable? If they doubt the US can manage this debt burden without eventually inflating it away, they demand higher yields. Third, political risk. The weaponization of the dollar and the financial system through sanctions has made even US allies nervous. If Russian reserves can be frozen, what about Chinese reserves? What about anyone's reserves? Every country is now reassessing the safety of holding large amounts of US Treasuries because they're realizing these assets aren't just economic instruments, they're political vulnerability. China, in particular, has been very clear about this. After watching Russia get cut off from SWIFT and have reserves frozen, China is systematically reducing exposure to the Western financial system. They're selling treasuries, buying gold, building alternative payment systems, and denominating trade in yuan. This isn't irrational. It's a rational response to the politicization of finance. Let me talk about what this means practically for regular people, because this isn't just a problem for bond traders and central bankers. First, mortgage rates. Mortgage rates track the 10-year Treasury yield pretty closely. If the 10-year yield stays elevated or rises further, mortgage rates stay high. That means housing remains unaffordable for many buyers. It means the real estate market stays frozen. Second, consumer borrowing costs, car loans, credit cards, personal loans, all of these are affected by the overall interest rate environment. If Treasury yields stay high, consumer credit stays expensive. Third, government spending. If the government is spending $1 trillion plus on interest, that's $1 trillion that can't be spent on infrastructure, education, defense, or anything else. Or alternatively, it means even larger deficits to maintain other spending. Fourth, inflation. If the Fed eventually decides to monetize more debt to prevent a fiscal crisis, inflation returns. Your purchasing power declines, the cost of living increases. Fifth, dollar confidence. If this situation deteriorates badly enough, if there's a failed Treasury auction, if yields spike uncontrollably, if the Fed has to intervene massively, global confidence in the dollar weakens. That has cascading effects on everything from import prices to asset valuations. This is why I'm paying very close attention to Treasury auction results, foreign holdings data, and yield curve behavior. These are real-time indicators of fiscal stress. What am I watching specifically? Several things. First, the bid-to-cover ratio at Treasury auctions. This tells you how much demand there is relative to the amount being offered. If bid-to-cover starts declining, it means demand is weakening. Second, the tail at auctions. This is the difference between the highest yield accepted and the expected yield. A large tail means the Treasury had to offer higher yields than expected to attract buyers. That's a sign of weak demand. Third, primary dealer takedown. What percentage of each auction is the dealers absorbing versus being sold to end buyers? High dealer absorption means weak end demand. Fourth, foreign holdings data from the TIC reports. Is China continuing to reduce? Is Japan reducing? Are there any major buyers stepping in to replace them? Fifth, the spread between Treasury yields and Fed policy rates. If long-term yields are rising while the Fed is cutting short-term rates, it signals market concern about fiscal sustainability. All of these indicators are flashing yellow, some are flashing red. This is not a stable situation. Now, let me be clear about my own positioning. I'm not predicting imminent Treasury market collapse or dollar crisis. These are resilient systems with a lot of inertia. Change happens gradually, then suddenly, but I am recognizing that the structural supports for unlimited U.S. borrowing are eroding. The assumption that foreign governments will always buy treasuries is proving false, and that means either yields have to rise significantly to attract buyers, or the Fed has to monetize, or some combination of both. I've personally reduced my exposure to long-duration dollar assets. I hold shorter-term bonds if I'm in bonds at all. I maintain exposure to gold and real assets that hold value regardless of currency fluctuations. I'm not betting on collapse, but I'm not betting on the status quo continuing indefinitely either. But again, this is what I'm doing based on my own analysis and risk tolerance. I am not a financial advisor. This is not investment advice. Everyone's situation is different. You should do your own research and consult with licensed professionals before making any financial decisions. What I am saying is this. Pay attention to the Treasury market. It's the foundation of the entire financial system. If cracks appear in that foundation, everything built on top of it is affected. The quiet withdrawal of foreign buyers from the Treasury market is one of the most important financial trends happening right now. And the fact that it's happening quietly, without major headlines or panic, doesn't make it less significant. If anything, it makes it more dangerous because people aren't preparing for the consequences. Watch the data, watch foreign holdings, watch yields, watch auction results. These will tell you how fast this situation is deteriorating, and understand that we are in uncharted territory. No country has ever run fiscal deficits this large while losing its traditional creditor base. What happens next is genuinely uncertain, but ignoring it won't make it go away. Stay informed, stay rational, and recognize that the era of consequence-free borrowing may be coming to an end.